Hi everyone, my name is Muzaki Abdillah, and in this video we are going to talk about stock. What is a stock? A stock, also known as equity, is a security that represents the ownership of a fraction in a corporation. This entitles the owner of the stock to a proportion of the corporation's asset and profit equal to how much stock they own. Units of stock are called shares. Let's make it simple. A stock is a type of investment that represents an ownership share in a company. Investors buy stock that they think will go up in value over time. A stock is an investment. When you purchase a company stock, you are purchasing a small piece of the company, called a share. Investors purchase stocks that they think will go up in value over time. If that happens, the company's stocks will increase in value as well. The stock can then be sold for a profit. In the 1600s, the Dutch East India Company, or what we know by the name VOC, employed hundreds of ships to trade gold, spices, and silks around the world. But running this massive operation wasn't cheap. In order to fund their expensive cruise, they turned to private citizens who could invest their money to support the trip, in exchange for a share of ship's profit. This practice allowed the company to afford even grander voyages, increasing profit for both themselves and their investor. The Dutch East India Company unknowingly invented the world's first stock market. Why would people do this? Most people do this in order to invest their money in a company and hoping their investment will grow up soon. In companies, why do they do it? In order to gain revenue or gain financial money that they can use to build or grow the company. Stock prices fluctuate throughout the day, but investors who own stock hope that over time, the stock will increase in value. Not every company does so. However, companies can lose value or go out of business completely. When that happens, investors may lose all or part of their investment. That's why it's important for investors to spread their money around, buying stocks in many different companies rather than focusing on just one. So, how do companies and investors use the market today? Let's imagine a new consumer goods that decides to launch on the market. First, they will advertise itself to big investors. If they think the company is a good idea, they get the first crack at investing and then support the company's initial public offering or IPO. This essentially changed the status of the company from a privately held business to a publicly traded one. Once a company's stocks are listed on an exchange, the public can trade them. Any company or individual who believes the business could be profitable might buy a stock. Buying stocks makes those investors partial owner in a business. Their investment helps the company to grow, and as become more successful, more buyers may see potential and start buying stocks. As demand for those stocks increase, so does their price, increasing costs for the prospective buyers and raising the value of the company stocks people already own. For the company, this increased interest helps fund new initiatives and also boosts its overall market value by showing how many people are willing to invest in their idea. However, if for some reason the company starts seem to less profitable, the reverse can also happen. If investors think that the stock is going to decline, they will sell their stock with the hopes of making a profit, before the company loses more value. As stocks are sold and demand for the stock goes down, the price falls, and with it, the company's market value. This can leave investors with big losses unless the company starts to look profitable again. Let's make it simple. If more people buy, then the price has to climb. If more people sell, then the price falls. It's very simple, right? And now for the next question, how sellers and buyers can match? At the start of the stock market, matching buyers to sellers are done manually on a trading floor. But now, it's mostly done automatically by trading system. And let's go to the next question. How to buy a stock? All of this theory about investing doesn't do you much good if you don't have any way to actually buy a stock. To do this, you need a specialized type of account called a brokerage account. These accounts are offered by companies such as Mirai Assets, Indo Premier, and many others. Opening a brokerage account is typically a quick process that takes only days. Opening a brokerage account is generally easy, but you should consider a few things before choosing a company, such as trading commission, functionality of the broker's trading platform, and many others. And now for the next question, how to make money in stocks? Stocks carry more risk than any other investment, but also have the potential to gain higher rewards. Stock investors earn money in two main ways. The first is capital gain. If the price of the stock goes up during the time they own it, and they sell it for more than they paid for it, it's usually called capital gain. And the second is dividends. Dividends are regular payment to shareholders, but not all stocks pay dividends. And that's all from me. I hope you enjoy it and see you in the next video.